Okay, so welcome everybody to the St Albans meetup. I see we've got a few people. I must make a call out to Seamus. So Seamus is a friend of mine from all the way from sunny Wales. So it's good to have Seamus on the call. So you're very welcome, Seamus. You're getting some waves there, Seamus, even if you can't see them. And I think we've got Sam on the call. Are you with us, Sam?
I am indeed. Yeah, I'm here.
And hi, Sam. Great to have you on. And a little bird told me it's your birthday today.
Yesterday.
Oh, yesterday.
I know. I don't look 24, do I?
You don't. You definitely don't.
Thanks, Chris.
You look younger, is what I mean. Obviously, Sam.
Obviously.
Yeah. Okay. But it's lovely to have you on the call as always.
Thanks.
I've got my pen and notepad ready because I always end up making copious notes. Are you happy? You should be able to take control.
Yeah, absolutely. I can do that.
And just a reminder to everybody, you'd prefer to take any questions at the end of your presentation. Is that right?
Absolutely. If you give me 2 seconds, and I'll just get this ready.
I like your top as well. So your top is advertised in your podcast.
It is, yeah. I wish that I was that I did that on purpose, but it just so happens that it's a little bit cold in my flat today, and I thought I couldn't possibly bring myself to put the heating on in September. So this is the first thing that I found to chuck on. Although whenever I wear this out, I always get some really funny looks off people who obviously have never heard of the podcast before. So
no, but they should have heard of Game of Thrones, even if they haven't heard of Game of Loans anyway.
Well, you would have thought so. But hopefully they don't get the two confused, because otherwise they'll be very disappointed when they come across my my podcast.
You never know.
But yeah, look, thanks very much again, Chris, for having me along. We always love coming on and sharing as much as I can with everyone with sort of what's going on in the mortgage market at the moment. And as always, I'm glad you have got your pen and paper, Chris, because it's been a busy one again. But before we kick off, look, there's all of my contact details at the beginning. I'm notoriously bad at telling people how to get in contact with me. I spend all my time telling everyone what's going on in the market, and then forget to tell everyone how to actually contact me if they need some assistance with anything. So obviously my mobile and email are up there, which is the normal way to get in touch with a human being. But if you are so inclined to also want to follow me on Instagram, Facebook and YouTube, that's how you can go about finding me. I'm on Twitter as well, and even TikTok for the kids. So if you're into that, then you can find me there as well. But just for a quick sort of agenda on what we're going to cover today. So first and foremost, as always, going to run down all the main stuff that's been going on mortgage-wise over the last 28 days or so. Then moving into a bit of bridging and development news. I like to split the two up because otherwise they can get a bit confusing. But there has been some positive news in the bridging and development world, which makes a nice change for us all. Then I want to move on to something that I think I've been talking to a lot of people about over the last couple of months, which is an investor pack, which is not necessarily the same as the kind of investor pack that you put together to maybe try and find angel investors, specifically for sort of with inexperienced developers in mind, what we can put together to help our proposition when it comes to getting development finance. And as always, I'll finish up with a Q&A. Chris will be very happy to know that Mrs. Norris isn't in this evening, so I can go on with the Q&A for as long as you need me to.
We've got you all night, have we, Sam?
Yeah, you got me all night. She's staying over her parents today, so yeah, you've got me all night, or until the cats start wailing anyway.
Okay. All right. That's good news.
So we'll kick off with we're talking about the mortgage market, which is good. Now, first and foremost, we got some news this week, didn't we? That Nationwide came out and said that we yet again for the consecutive, I think third consecutive month possibly, we've got a record highest average UK property value. So my question to all of you is when do you all think the dip is coming? Whether you think it's a crash or a dip, when is that likely to occur? Because every time I start to make a bit of a play for this, I always seem to be getting it wrong. So who knows? Who knows where it's at? But hopefully this is news coming from one of our major lenders. And I know Halifax, I'm sure, will back them up soon when they come out with their indexing. But yeah, yet another month of record highs in the property market, which hopefully should give lots of comfort to our lenders. However, not so good news is that we're starting to see on the residential side of things that some lenders are now not accepting furlough income. We had TSB make this announcement earlier on this week that they were not taking it at all. And NatWest have also confirmed that they will only take furlough income if there is a guaranteed return to work date in the diary. So although this is mainly on the sort of the residential side of things, what happens in the residential market can sometimes tend to then have an effect on the buy-to-let market. It might mean that we start seeing some buy-to-let lenders not taking furlough income into account when they've got their sort of minimum income requirements. So watch this space there, but starting to, a few cracks to show in that. So probably the sooner that the furlough scheme ends and everyone gets back to work, the better for many of us. I know my wife's still on furlough, and she's if she's not driving me nuts, she's driving herself nuts. So for her benefit, I hope she gets back to work soon anyway. Now, another big bit of news over the last month is that Vida Home Loans, one of the lenders that was actually struggling quite a lot during the course of lockdown, have come back into the market. I think I mentioned that on the last meeting actually, but now to make a real play for things, to really sort of ramp up their underwriting team, they've launched the first 85% loan to value limited company buy to let mortgage since coronavirus hit us. So you can look at this a couple of ways. Personally, for me, I think that because Vida got a bit of a bad rep during lockdown, this is probably their way of getting an influx of new applications, probably. But I kind of, and I say this with as much positivity as I can. A word of warning for a product like this. Something that I've been talking about a lot over the last couple of weeks on social media has been this. We've started to see quite a few people over the last year or so start to succumb to having over leveraged portfolios in the background, which has hindered their new applications for mortgages, or whether it be refinance or purchase, because lenders are, for the last few years, have had to do background stress testing on your whole portfolio if you own 4 or more properties. That is the rule that has been pushed down on them from the PRA, the Prudential Regulatory Authority, if I can get my words out. And so we've had a few people over the last couple of months that have actually struggled to get new mortgages because they're over leveraged on their portfolio in the background. So if you need to take out an 85% loan to value mortgage, great. If you don't need to, I would err on the side of caution there and not. But the fact that Vida have come back into the market at 85, does show that at least some lenders out there are starting to get a bit more comfortable with what we're seeing going on in the property market as a whole, which is confident. Now, on the flip side, Vida have also been in the news because they are one of the first lenders to really, especially on the buy-to-let side, really start pushing on getting information about bounce back loans, payment holidays and civil loans that you might have had or taken out during lockdown. We have had a case in the last week where Vida they haven't just asked for information about it, they've actually asked for information to be sent from the client's accountant to sort of back up why these were taken, what they're going to be used for, what they have been used for, and what their repayment strategy has been. Now, we've actually realized that the cash that's in our client's company account is more than the amount they've taken out as a bounce back loan in this instance. So what we've been able to say to Vida is, well, if they wanted to pay back their bounce back loan tomorrow, they could. But what I'm trying to sort of stress to a lot of our clients is, have your story straight with this. Don't try and make up reasons why you've taken the payment holidays. Be honest. If you took the payment holiday because it was easy, but you've then since stopped it and repaid it and got yourself back up to scratch, just be honest and say we made an error. Lenders are, underwriters are human beings at the end of the day, and they do have some discrepancy over this sort of stuff. It's why it's not in a decision in principle. So it's not a computer says no scenario. It's probably more a straw that breaks the camel's back scenario. So yeah, if you've taken out any of these, get your story straight and be honest with lenders. Don't deceive them. Be upfront and honest with what you've used it for and how you're going to pay it back. But we are seeing Vida are the first ones to ask for specific information about it. But that's not to say that other lenders aren't going to sort of follow suit over the coming months. So be prepared. One thing in the commercial space for mortgages that we're noticing is that many of the traditional commercial lenders are not actually now lending yet on full commercial property, which you might think is really weird. You're a commercial lender, surely you want to lend on commercial property. Not necessarily the case. We do quite a lot of commercial lending, and so the normal players such as your Interbays and HTBs. The two prime examples, HDB is Hampshire Trust Bank, by the way, for those that aren't in the know. Two real prime examples are lenders that are only lending on mixed use, i.e. part residential, part commercial properties, not full commercial. So if any of you that are out there that are either in the commercial space or thinking that you want to start getting into it, extra sort of research is needed really to go into who will lend to you and what sort of lending options you've got, because when you've got players like Interbay and HDB coming out of the equation, things are starting to look a little bit slimmer. So definitely time to do a bit of extra research on that side of things. Staying on the commercial side, one thing that we've also noticed on the back end of lockdown is the kind of decline of yield-based valuations for HMOs, specifically sui generis HMOs, which are usually the sort of the sector of the market that lends itself pretty well for these yield-based valuations. We've actually had Shawbrook recently come to us and say that they won't do a yield-based valuation, but we managed to get that case away with LendInvest. So LendInvest are doing it, Shawbrook aren't. We can't confirm every single commercial lender, whether they are or they're not, but it is something to be wary of. There are fewer and fewer looking at this at the moment because they are thinking there's potentially going to be a dip in the market at some point, they're very wary of over leveraging on property based on the bricks and mortar valuation. Generally, you go for a yield-based valuation if you're looking to pull cash out to go and increase your portfolio or something like that. So if you are trying to attempt to do this, or if you did try and attempt to do this, lenders are worried that this is going to take you potentially into negative equity if you're looking at the bricks and mortar valuation, especially if we do see a dip or even a crash over the next 12 months. So just be wary that if you're in that space, or you're in the HMO space, and you've got sui generis planning for your HMO, you're not necessarily guaranteed to get a yield-based valuation. So do your due diligence beforehand. So moving into the bridging and development space. One of the good things is, and that's a really nice thing for me to read and tell you all, is that bridging rates are starting to come down. More and more lenders are coming back into the market. I know this because my LinkedIn, my emails, my Facebook, my text messages and WhatsApps are full at the moment of bridging lenders, both new and old, who are contacting me, telling me that they're active, they're in the market, and they want to meet me and let's go out for coffee and drinks, all this kind of stuff. So that's a really good sign for me. When I'm getting asked to go for coffee every week, then I know that people are coming back into the market. And that's certainly been the case. I was lucky enough to spend a couple of days in London last week and did consume probably far too much very fatty coffee last week, seeing some bridging lenders and getting the lowdown on what they're up to. But yeah, the good news is as well is that this is helping us push up those loan to values. If you remember last month, for those of you that were here, I was saying that a lot of lenders were limiting, although they might be saying that they're lending at 75%, in reality, they're limiting their lending at sort of 65, 70%. These lenders here are genuinely lending at 75%. Funding 365, who I saw last week, are back in the market. They've returned to the market over the last few weeks. They're in at 0.79 for a 75% loan to value. LendInvest 0.8. Hope Capital winning the day at the moment at 75% at 0.75%. They call it their 75 product. I don't know where they got that one from, but it just goes to show that with more increased competition, more funding lines, we're seeing the quality of the products, the higher loan to values, the lower rates coming back in. And realistically, there's only a few sort of major players to come back. What this is hopefully going to do is there are a few lenders out there that, in my personal opinion, are taking the mick a little bit, utilising what's going on to really drive up prices, and hopefully they're going to start coming back to where they should be soon. We're talking about lenders that are doing 1% plus bridging loans at the moment. Hopefully they're going to get the memo that pricing is coming back down, and they need to do that. Otherwise, they're going to start losing out on cases. But good news is the market is starting to fill up a little bit better, with more lenders coming back, and this is only going to hopefully improve the whole sector. Now, sticking with Funding 365, this was one of the lenders that I met up with last week. I've always been a massive fan of theirs because they get the job done very, very quickly. If I'm lucky, they're one of their sort of chief underwriters is dedicated to our company, so we only have the same underwriter every single time that we use them. We have the same situation with quite a few different bridges, but in particular, these guys have done some pretty quick bridges for me over the years. So I was really happy to hear they've actually moved into the development space as well, which is great. But the good thing about this particular proposition that they've got is, number one, they're quite happy to lend to relatively inexperienced developers, which is really positive. And actually, they'll go all the way up to 70% loan to GDV. That's gross development value, for those that aren't into the development side of things, which is really, really high, even sort of pre-COVID. That's pretty much the top end. So a really good product that they've brought out, which is really, really positive. Now, I mentioned at the top this idea of investment packs or investor packs, and I wanted to break this down because what I'm seeing more and more of at the moment is sort of relatively inexperienced developers. Maybe they're people that have been investors before, they've bought property to rent out, but they're looking to maybe get into the space where they can add value to properties by actually developing them, and maybe even doing things more, bigger, larger than that. With some of the sort of changes in PD rights, seeing a bit of sort of commercial to residential conversion, that sort of thing. And for those that aren't, particularly experienced, this can really go against them when we're looking for development finance. But there are a few things that we can do in order to sort of balance that out. And one of the big things that I say to my clients is, development finance lenders are looking to feel comfortable. They want to see a good story, they want a good proposition, and they want to feel comfortable that at the end of the day, the job's going to get done and they're going to get their money back. So one way in which we can do this is to sort of expand on the development appraisal that most will want anyway, and just create what I would sort of call an investor pack. And here's what I would, what we see our best developers putting into their packs. So the beginning of it should just be a bit of a background of who you are, what you do, any kind of interest that you've had in property in the past, whether that's, you've got some sort of sector experience, maybe you're a builder or a construction worker, so you actually have experience of being on site. Maybe you've been a quantity surveyor, so although you've not been a principal developer before, you have experience of actually getting the job done on site, so to speak. Even any sort of courses you've attended, even if it's Samuel Leeds, just put it on there anyway. It's still gonna show that you've got some kind of training background, mentorships you've done, masterminds you've done, anything like this. Get it in there so that you're creating a real sort of story surrounding what your current situation is and who you are and what you've done so far. One thing that is always really, really important is show your research. You know, we all talk about this gold mine area. Once you've found your area of investment, talk about why. Why is this an area of investment for you? Is it because it's relatively local? Is it because it lends itself to HMO, which is what you're looking to do? You know, anything that you can put together. You know, is there a new I don't know, university campus being built? Is there a new hospital wing being built, which is going to help you if you're an HMO investor, as I mentioned, or you know, various different things to do with this particular area. Put it all in there. It all shows and heightens your professional approach to things, and just makes you look a better proposition to a particular lender. Now, number 3 is a really, really important one. I saw a cracking your team section in an investor pack that one of my clients put together relatively recently. And it was really, really cool in that they had black and white photos in circles, kind of almost like a ladder going down the page, one either side, with like then a little bit of sort of commentary coming off each of them, to sort of really highlight all the members of their team and all the experience that they're surrounding themselves with. So in there you might put your contractor, project manager, accountant, solicitor, broker, mentor, you know, anyone that is within your team, your power team. Include them in there, and include reasons why they're there, their experience, and what they're bringing to the table. What this does is, as I write there on the presentation, anyone on board is making your proposition stronger. You are essentially saying, I don't have the experience, but look at all the people around me that do have the experience, Mr. Lender. There's no reason why this project shouldn't succeed. And actually, there was one pack that we saw recently where the client actually said, I will not be on site. He actually put on there that he himself will not be on site. His project manager is his eyes and ears, and he will rendezvous with them once or twice a week, and that is it. So putting something like that is perfectly okay, and can actually add to the strength of your proposition if you're not very experienced. Now, on a case-by-case basis, you do want to also include your development appraisal and schedule of works in there as well, because you want to show the numbers. And that's why I said at the top of this that this is kind of almost like taking the development appraisal and really growing it out and just making it a hell of a lot more presentable. And also, look, with something like this, don't just stick it on a Word document. Make it look pretty. If you've got a logo for your company, get it on there. If you've got a color scheme for your company, use it. There are so many tools out there, Adobe, Canva, you know, free tools that you can use to actually tart it up and make it look really great. Or just go on to something like Fiverr and you can pay a VA in the Philippines $10 to do it for you. You know, they really do a really high quality level of work. Anything you can do to make yourself look more professional, this is the time to do it. So I really think that you should put some really good time and effort into doing stuff like this. And we've seen the difference in the kind of terms and lenders that are available to clients that do this. So hopefully people's pads aren't completely full of notes, and if anyone's got any questions, then yeah, feel free to ask away now. There you go, Chris. I think you're back on.
No, that's fine. I will get. Sometimes it takes people a minute to get off mute. So that was very informative. It sort of amazes me from month to month, Sam, how much is changing in the lending environment, in actual fact.
Yeah.
And it must be difficult, in actual fact, to keep on board, you know, for you to do your job, because there's so much volatility in the market. And, you know, today's been a really good example of that. If anyone has any got any questions, please jump in. There was a message on the chat, I think it's from Ronak, that said when you were talking about the photographs and putting your sort of team together in the investor pack, Ronak said it sounded like the one that he sent to you. So
okay, yeah. Rodak had an investor pack that he sent over that was very, very good. So yeah, well, I'm sure Rodak won't want to share that with everybody, but yeah.
No, that's great. for a client of mine, so I can't share. But sounded like something similar that, yeah, from what you were saying, something similar that I'd sort of sent through to you.
Yeah, absolutely. And yeah, stuff like that. It just makes all the difference. I'm a big, I don't know if anyone on here has read a book called The Slight Edge, but I'm a big fan of, anything you can do, even if it's only going to make a very, very small difference, it's worth doing, just to improve your situation. And it amazes me actually, Chris, how many people, when I talk to them about this kind of stuff, and the response I get is, that sounds like a lot of work. Like, yeah, I'm not trying to hide the fact that it's work. I'm trying to tell you this is just what you need to do to set yourself apart from other people, and to really help yourself, get the absolute best lending possible. And if that's the difference between you getting a bridge at 0.75% or a bridge at 1.3%, if that's literally, and that could be the difference. That could be the difference. And if that's the case, then that is, 2 or 3 hours well worth putting into something like that. And it always blows my mind when I hear people say, oh, yeah, that sounds like a lot of work. So, well, you've decided to become a property investor. It's not easy.
Yeah. I think, I couldn't agree more. Well, I was thinking, in actual fact, Sam, yes, it could be the difference between the interest rates you pay. It could also be a difference on whether you get lending or not. Whether you actually, have got the funding to do the development that you want to do. So I thought that was really well said. So in terms of the investor pack, did you offer like a template or something that people can?
I haven't got one at the moment, but certainly there are. Ronak quite rightly said the one that he's got is obviously one of his clients, but I do have clients that potentially would be comfortable sharing. So what I might do is, is sort of go and ask a few of them if they're happy for me to do so, and if so, I can always put a message onto the WhatsApp group, and anyone that's interested can let me have their email address, and I can send you a copy. Otherwise, probably I could probably doctor one that I've got and sort of put something together. So I'm sure I could do that. That wouldn't be a problem.
That'd be really good. So typically these are running to sort of what, 3 or 4 pages, or?
So I've got one that's about 20 pages long, which might be a little too long for some lenders. But if you've got one page at the beginning, which just gives you a bit of an overview as to who you are, a nice professional picture of yourself. But the thing is, there might be more of you. If there's 4 directors in a company, for example, that might be 2, 3, even 4 pages just of introductions into the individuals that are involved. Depending on how big your team is, that could be a couple of pages. Depending on how much you want to put into the, what about your investment area, things like that, a couple of pages, 3 pages potentially there. The development appraisal itself could be a page. The schedule of works could be another page. So, easily this could get up to a 10-page document. You'd have what you need in there. There's no point making it, really, really short, but there's also no point making it too long. It needs to be somewhere in the middle, really.
Yeah. I think that's good about in terms of painting a picture. I mean, you're asking these people, if you look at it from a lender's perspective, in terms of lending hundreds of thousands, millions of pounds, to put a document that helps them understand what thinking you've had, what your proposal is, what your background is, what skills you've got, what your team's like, how the numbers stack, what research you've done, it's got to all help.
This is something I say to clients all the time: is put yourself in the lender's shoes. And this is very prevalent, actually, more on the bridging and development side rather than the mortgage side. Because with a lot of mortgage companies, we know there's an element of computer says no, or computer says yes. Whereas with bridging and development, it can be a bit more bespoke. It can be, there's a human element to it. And I say to clients all the time, we need to persuade these people to lend to you. They don't need to lend to you. They don't have to lend to you. And if they don't want to, they will just say no, and that's that. And if they don't feel comfortable lending to you, they won't lend to you. So, and that's it then. It's not a case of, oh, let's try again and put together a better proposition. You usually get one crack at the whip at it. And they might come back and ask questions back and forth, but it will get to a stage when they just get sick and tired of it, and don't do it. And certainly I saw that when I was starting out in my career and I wasn't as experienced as I am now. I was putting sort of more flimsy proposals, unfortunately, together and sending them to lenders. You live and learn, and I saw it the hard way and lost clients because of it. But I'm thankful for that on a selfish level. I feel bad because of maybe a poor level of service that I gave to those clients at the time. We are talking a number of years ago now, but I saw it firsthand. This is the reality of it. The better the proposition, the better the lending. End of story.
Yeah, that all makes complete sense. Anybody got any questions for someone? Now, I've got a couple of questions on a couple of other points, but just before we move off the investor pack, any questions from anyone?
Yeah, this is Uwa here. Can you hear me? Hi, how are you doing, Sam?
I'm good. How are you?
Good. Good to see you again. Thanks for that session. My question isn't so much on the investor pack, but more on the Vida situation with the bounce back loans. I've got sort of two questions from that. So the first is, does it make a difference if your company is a real estate company anyway, a property development company officially on Companies House? Do they look at that favorably? And the second question is, do they look at CBILs or BBLs that you've taken out in other companies that you own? Do they factor those in?
Yeah, I'll do those the wrong way around if that's okay, because it's one sort of leads into the other. They will look at your entire proposition, your entire background. Remember, even if you own a real estate company, you're director of a SPV, whatever it might be, that's the owner of this particular property that we're mortgaging. There's a common misconception that just because you're a limited company director, there's some sort of barrier between yourself and the underwriting and the lender. That's not the case at all. They want to know everything about you the same as they would if you were just taking out, a standard mortgage, to be quite honest with you, in your own name. So everything that's going on in the background, they will want to know about. So, when I was saying in there about creating a story, I wasn't saying make up a story. I was saying more, have your story straight, really understand. We need to make them understand why you did it. And even if there was an element of, it was a bit of an error, as it turns out to be now, but you've done it, being very honest about that and not trying to sort of deceive the lender in any way. On to the second part of that, which is about it being a real estate company. I wouldn't say they would look any more favourably or unfavourably on it. The example that we've had recently is actually that the bounce back loan and the payment holidays were obviously taken out by the limited company that owns the properties. So that was within the real estate company. But the bounce back loan came from a retail company that was in the background. So again, they were having less. They weren't online. They took out some money to go online and to set up sort of some storage for their stock and all that kind of stuff. So there was a very, very good reason why they took out this loan. And also, as I said, we had to just create and help the lender understand how that loan was going to be repaid, because I genuinely am of the belief that we're heading for a bit of a problem in sort of 9 months' time or so, when people need to start repaying their bounce back loans and they start to realise how much they've actually got to pay on a monthly basis. And I actually reckon there's going to be a really big market. Number one, for refinancing. Lots of people are going to be refinancing to pay these off so that they can spread the cost over a longer period of time. Secured lending, unsecured lending. Don't be surprised if there's new companies that pop up that will specialize in refinancing bounce back loans and basically allow you to repay it for a higher interest rate, but over a longer period of time to allow you time to repay it and reduce your monthly costs. That's my putting my stick in the mud on that. So to answer your question, I don't think it's really going to make too much difference whether that bounce back loan is within or without the real estate company, to be honest with you.
That's great. Thank you very much.
Great questions, thanks for that. Okay, Sam, as always, fantastic information. Really helps us as investors know what's going on in the market. Yeah, and I think you raised really good points about repaying the bounce back loans and the loans that seem very attractive at the moment. You also mentioned about obviously the payment holidays, with lenders asking about those as well. So all really interesting stuff. So thank you very much for that, Sam.
No worries.
So your slides and everything will be available for people afterwards.
Absolutely.
Yeah, brilliant. And your contact details we've got, etc. Okay, thank you very much. Just moving on. I asked Graham Kinnear to present to us. Very excited that Graham has agreed to present to us tonight. He's got a wealth of experience in the property market and sector, and is very, very well qualified as well. So Graham, you should be able to share your screen, or I can share your pack if you would like me to. I can whatever's easiest for you, Graham.